Abigail, let's stick with those global markets. We're joined now by Daniel Lacalle, Tressa's chief economist. He is also the author of Escape from the Central Bank Trap. I don't think we've escaped from very much during the month of December, and certainly not central banks. The Fed certainly causing quite a lot of volatility this week. Certainly. John Williams trying to wind a little bit of that back over the last couple of hours. What have you made of the price action in December? What have you made of the gyrations that we've seen in these global markets?
I think that what we've gone is from a euphoria shock created by the expectations of synchronized growth, of improvement in emerging markets, rising oil prices, etc., to synchronized sell-off because of the fears of a radical slowdown, very quick deleveraging, and loss of liquidity. And so we've lost about 15 trillion, more or less, in the markets. In the global markets of market capitalization, which is about 1/5 of how much it went up in terms of market capitalization post-QE. So I think that we've lost a lot of the hype, a lot of the froth that was embedded in those expectations, and that what we're seeing right now is where you can start to look at opportunities, in my opinion, because while it is true that we're seeing a global slowdown, we're seeing downward revisions of growth, etc., we're not necessarily in an environment that we think is going to lead to a global recession or something really dramatic.
So things aren't maybe as bad as the markets appear to be portraying at the moment. A lot of investors that I'm talking to are saying, I'm going to wait until January before I put on big positions. I want to see what happens in the first few weeks, months of next year before I'm prepared to commit to some big conviction trades. What kind of signals are we going to be getting in January and February that are going to allow people to maybe take a more positive view of the world? You just said that things aren't that bad. So what are we going to get? What's going to tell me that actually the world isn't that bad in January and February?
I think that January and February we're likely to see consensus, for example, showing that growth estimates are not going to be revised down dramatically further. I think that also the fact that investors are getting used to what many actually believe was not going to happen is that central banks are actually raising rates and stopping QE, like in the case of Europe, and that is actually a positive. Funnily enough, is that is markets getting out of the hype, getting out of the excess created by the central banks and looking back at fundamentals. I think that also the reality of not just macro growth, but also from the corporate perspective, is that earnings estimates are continue to be revised down, but not dramatically. That guidance is not that bad, and I think that we're seeing it as well today with some of the companies that are publishing results.
Nike,
yeah, absolutely.
What are your growth estimates for next year, Daniel?
Gold estimates. Well, I think that
growth estimates.
Growth estimates. Yeah, I think that. Sorry about that. Gold has been one of the topics that we've been discussing this morning. Yes, growth estimates for the next year. I think we're going to be moving around in a global growth around 3.13%. I think it's going to be revised probably down to the level of 3%, but still, you see, moderate but not dramatic levels of growth.
Well, as you mentioned it, let's get to gold then. We have seen a nice bounce. What are your estimates at Tracy for gold next year?
Well, one of the key factors that we're talking about and that I have been mentioning for a while is the risk of continuous disinflationary pressures. Technology, commodities falling, China slowdown, and currency depreciation from countries with very high US dollar denominated debt. Therefore, disinflationary pressures don't help gold in an environment in which growth is okay but not phenomenal. I think that gold can be an asset in order to preserve some, let's say, value, but not, I would consider, something that would rise dramatically in an environment of slowdown, but not dramatic recession.
Let's come back and talk a little bit about how we're going to invest money next year. The Chinese authorities came out a little bit earlier on and signaled that they are going to be delivering significant amounts of stimulus maybe next year. They're trying to slow the economy. They're trying to deal with the slowing economy. They talked about tax cuts. They talked about all kinds of things. How big an impact, if the Chinese decide to go for it in terms of that stimulus process, will that have on the global economy next year and the investments that I'm going to be making?
Yeah, I think that we need to be cautious about it, because remember that the Chinese have been implementing stimulus after stimulus since 2008, and that it is already, the Chinese central bank is already conducting a very aggressive monetary policy. It's very accommodative and injecting liquidity into markets. Therefore, we need to be at least cautious about expecting radical changes. I think it's basically what they're trying to do is to moderate the slowdown. But the slowdown means still, 6% growth, something like that. No? So I think that we should be cautious. And if there's a big bump in commodities or in inflation assets, is to unwind that trade into the second half of the year.
John Williams from the New York Fed coming out saying that the kind of the rate hike view is guidance, not a commitment. In 2015, 2016, the Fed kind of got over its skis a little bit too much and had to pull back and it had to pause. Is that what we're about to see here again? A prolonged pause from the Fed. John is also coming out and talking about the fact that the Fed is listening to the markets. What do you expect from the Fed next year? It's signaling to. Are we actually going to get to?
I hope that the Fed will listen to the data, the economic data, not so much the markets. Because the mistakes made in the past of delaying rate hikes because of a market bump or market volatility, that actually has led to some problems of losing the ability to build tools into a change of cycle. Therefore, I think that obviously it is very logical that the Fed will not raise rates as much as expected at the beginning of the year, because inflationary pressures are coming down. I understand that, but I hope that they don't believe that stopping rate hikes is the solution. More importantly, because it would give a very, very bad image, a very bad information to the markets. It would signal that the Fed knows something that is much worse than what we anticipate.
All right, Daniel Lacalle, Tracy, Chief Economist, he's staying with us. Let's get now to the first word news. Here's Courtney Donohoe. So
2019 doesn't look very good. Consensus continues to expect a growth of earnings that looks impossible to me, to be fairly honest, and I'm trying to figure out how they get to almost double-digit earnings growth. Not just that, but also you have mostly multi-mega-cap conglomerates that have acquired profits at very high multiples abroad. They are going to see the negative effects of commodity slowdown, currency risk, etc. So it is quite difficult to see what is going to drive markets further, because at the same time you have the slowdown in the economy in Europe.
None of these things sound like they're going to change anytime soon.
No, they're not going to change because
so when does the market? Are we just done for this cycle in terms of the investment case around Europe?
I think that the investment case around Europe is nowhere to be found in the large names of the indices. You have to look below that. You have to go to companies very much in particular. And if you look at actually in the markets, they've not done particularly badly. But at the end of the day, you're talking of names that are ex-growth and that are not going to deliver stronger growth next year. In fact, they're going to see the slowdown coming from both emerging and the local markets. And it is what it is. You can't fight demographics, low growth and high taxes through the stock market. It's not going to deliver multiple expansion. It's the typical case of a value trap.
So how do you invest through Brexit, Daniel?
Well, I'm actually quite more positive on the UK than on the growth of the European Union. I think that we are seeing that the latest economic data from the United Kingdom is showing much stronger numbers than actually what we have seen from the European Union as an aggregate, obviously hindered by France and by Italy. But and the slowdown in Germany. But what I think that the way to look at it is, if you look at the FTSE, you have companies that are global, that are mostly commodity related, that have most of their earnings outside of the UK. So they've actually performed quite well precisely because of that. And I continue to believe that that is what you need to look for. You need to look for companies that defend margins, defend their growth, and that have the lowest exposure to obviously stagnating markets like the Eurozone in the next couple of years.
What's your base case for how Brexit actually happens, and what's your base case for the British pound?
Yeah, that's a tough one. That is definitely the million-dollar question. I think that there will be a negotiated process. I think that the agreement that has been reached and that was rejected is a base case to start a new negotiation. I think that neither the European Union nor the individual countries can afford to get to a no-deal Brexit because of the massive trade surplus that exists between individual countries and the UK itself, and at the same time the UK has a tremendous surplus in services with the rest of the European Union. So I think there has to be a deal that is mutually beneficial. It is not going to be obviously the one that we have seen, but it'll take probably longer. Nothing that we haven't seen in the past, but I think that I'm actually positive that there will be one.
Daniel's going to stick around. Daniel Lacalle, Tress's chief economist, is going to stay with us. We are 9 minutes away now from the end of regular trading here in Europe. From London, from New York, this is Bloomberg. Yeah. It's interesting considering the kind of, as you say, the wild swings. We've seen wild swings all week. Daniel Lacalle, Tress's chief economist, is still with us. Vince Signorella as well, Bloomberg FX strategist, is joining us as well over in New York. Daniel, let me start with you. How big an impact is the Fed going to have next year? We've seen these comments coming through from John Williams today. He's trying maybe to walk the market a little bit off the ledge that we saw it walk out onto earlier on in the week. And then we've seen some really dramatic drops. Is the Fed going to pause? Are we going to see the Fed maybe delivering something a little bit more market friendly in 2019?
I don't think it will pause. I think that the message from Powell saying that nothing is going to stop us from doing what we have to do is important. However, does that mean raising rates 3 times? No, because this, as we mentioned before, disinflationary pressures remain. But the Fed needs to build tools into the next cycle, and I think that that's a much more important factor than the moves and the volatility in markets. And I think that also because, as we saw before in the chart about what happened with the taper tantrum, what happened in previous occasions, those things end up being absorbed and adjusted by markets, and markets need to get to the fact that that interest rates are going up, and that should not be a problem. That should be an opportunity, in my opinion.
We have Vince Signorella with us on the New York set. Vince, sum up the week's trading for us.
Oh, wow. Sum up the week's trading. I think the week's trading has a lot to do with year-end. We're seeing traders not really want to hold positions going into the final days. From an equity standpoint, PMs being marked to both their peers in the S&P 500 average. As that market's collapsed, there's no real incentive to hold on and be underweight versus your competition. For the fixed income and FX guys, the month is pretty much done. So whatever trade you're being put on by versus a customer or whatever, you're just sort of dumping that back out again. No one's holding anything into 2019. And I think what we've seen is this has been a continuation from early October, where oil prices rolled over as a result of the trade situation with China. That still persists. We seem to be energy prices can't seem to hold any rallies, and the equity markets follow. So that volatility, I think, is going to stay with us for a couple of more weeks, at least until the middle of January.
Vince, as you say, a lot of people don't want to hold positions, but you also ask them what their conviction trades are at the beginning of next year, and they don't have any. They're really worried about kind of what the beginning of next year is going to look like. Usually at this time of the year, you say to somebody, you say to a PM, what do you think you're going to make money on next year? They'll give you 3 ideas. Boom, boom, boom. Now, none of that. So to what extent is that affecting what we're seeing this week as well?
Well, you look at yesterday. We saw one of the highest volume days of the year, right? So you can't say this is on limited volume. And so it's a lot of chop. And I think what you just said plays into that. Because there isn't a conviction, there's just all of this volatility that's going on as people are moving in and out of trades without the real confidence to hold on to anything. The only thing I'm hearing from people and for what trade they want to carry into 2019, and this could be a very dangerous one, is to start to pile into EM and get out of the dollar and get out of U.S. assets. What we're going to see into quarter end, year end, month end for 2018 is a potential for a large dollar buy going through the market because of the equity sell-off. If that happens, we'll see a runoff in EM. And if portfolio managers are putting that position on now or have been putting on that position, they're probably going to start the year in the red, which is not a comfortable place to be.
Would you be comfortable with that, Danielle? Would you be comfortable with recommending that?
I actually agree with what Vince was saying. I think it's a very, very dangerous trade into a massive maturity wall of U.S. dollar-denominated debt in emerging markets, which piled up into U.S. dollar-denominated debt in the years in which they perceived that the dollar was going to be low and that interest rates were going to be low as well. So I think it's a very, very dangerous position because it is true that emerging markets are falling quite dramatically, but they are very, very far away from the corrections that we have seen historically in a bear market for emerging markets. And those maturities that we were mentioning before in US dollar debt and also in local currency are going to be refinanced at obviously much higher rates than what we see in right now. And that makes obviously liquidity and the impact on equities important. And I think that to revisit, to look at 2018 as some sort of, I would say, parenthesis, and that we need to go back to repeating the same trade that was recommended at the end of 2017, which was to go short the dollar and long emerging markets, is very dangerous because we're not paying attention to the slowdown, to the currency risk, and to the maturity wall in those US dollar-denominated bonds.
Daniel Lacalle, Tressis, Bloomberg's Vince Signorella. Thank you very much indeed. Vonnie.
Thank you.